Live from Bloomberg's World Headquarters in Midtown Manhattan, I'm Matt Miller.
And from our studios in Washington, D.C., I'm Kaylee Lyons. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Coming up, Bitcoin is booming. Markets stabilized after a dramatic week that saw 3 banks collapse. We'll have an in-depth look at how crypto exposure helped to unravel Signature Bank.
And with the failures of those 3 banks, which others can the crypto industry turn to now? We'll ask Kavita Gupta of Delta Blockchain Fund.
And finally, who is to blame? Barney Frank is pointing the finger at regulators, saying that they singled out his bank because of the crypto taint. They deny that. Perianne Boring of the Chamber of Digital Commerce weighs in.
All right, so all of that is ahead. We certainly have a lot to get to. But first, let's get a snapshot of the market. Check out CRYP Go on your terminal. And what you will see is the rally is continuing in digital assets. Bitcoin is now up for a 4th consecutive day, up 7% today alone. We are inching very close to the $26,000 level. This rally has been remarkable. And Matt, I know you have some theories, but of course, it's bleeding through the other digital assets and those stocks tied to it as well. Ether is up about 6% on the day, trading at $17.69 at the moment. And then when we look at some of those crypto-related equities, Marathon Digital, for example, up nearly 14% on an intraday basis, and Coinbase rallying once again, too. It is up 8.4% today, Matt.
Yeah, I think it's just interesting to look at Bitcoin specifically, Kaylee, because we did have it come up through 26,000. In fact, it was higher than 26,500 for a moment amid this SVB turmoil. My question is, are people pulling Bitcoin off of centralized exchanges, out of banks that do work with crypto, leading to a conversion of fiat to crypto? And that's why we're seeing this rally, because otherwise it seems kind of against all odds, keeping market participants cautious of remaining risks. Take a listen.
Bitcoin's on a tear.
Prices up despite all the bad headlines.
Most of the tech IPOs are down 50, 60%, and Bitcoin was down way less than that.
It's almost ironically become somewhat of a safe haven.
Long-term, events like this are massively bullish for the crypto complex.
There are risks remaining.
A chilling effect.
Many of the assets in crypto will actually be hurt by this.
Very, very negative crackdown on crypto.
Larger banks have a disincentive to servicing the crypto space because it only brings them trouble.
Riding the crypto and tech bubble in VC and hot money, you're probably in trouble.
Sonali Basak has been following all of the twists and turns for us in this drama, and she joins us now for a closer look. Sonali?
Matt, certainly dramatic. In the course of 5 days, 3 banks have failed in the United States, and those lenders were critical counterparties for a huge part of the crypto industry in the country. They served as a place where giants like stablecoin issuers Circle and the largest U.S. crypto exchange Coinbase once held deposits. These banks warmed to the crypto industry before any other banks really got on board, and some of them have remained the largest financial institutions to the crypto world before they shut down. Silvergate's announcement of liquidation was the most dramatic, given about 90% of its deposit base was tied to the crypto industry. But Signature also had significant exposure, and the bank's closure was far more abrupt in a surprise announcement late on Sunday night. Among its directors had been Barney Frank, a key proponent of the Dodd-Frank Act in the wake of the 2008 financial crisis that transformed the financial industry. He said crypto was a common thread behind the bank closures and a new and potentially destabilizing force to the financial system. But he also said that financial watchdogs were sending a message to get people away from crypto. He told Bloomberg that Signature was singled out to be the poster child for that message. Nick Carter of Castle Island Ventures had long been critical of the government's actions to stifle the crypto industry, referring to the efforts as the Operation Choke Point scheme to marginalize specific industries by choking off their banking access. Frank's comments added fuel to Carter's argument, and Carter's point about Signature was that its assets were not as troubled as Silicon Valley Bank, where the concerns about bank runs and liquidity mismatches were so dire that it quickly became the second largest bank failure in U.S. history. Signature, once closed, became the 3rd largest. there are real ramifications in real time. One big example of this, Silicon Valley Bank was a known banker to Circle, which had $3.3 billion worth of cash reserves in the bank, which amounted to about a third of its cash reserves. The market was concerned that this money would be trapped, and the USD stablecoin lost its peg to the dollar, trading about 88 cents on the dollar during the weekend. But once the United States announced its rescue of SVB and Signature clients, promising that all depositors would be made whole, that stablecoin rose back to meet its peg again as holders gained security that the underlying cash was safe. Circle CEO Jeremy Allaire has moved money from SVB given the bank's failure. But as he looks forward, he's voicing more criticisms about the fractional reserve banking system in the United States, and he's looking to advocate for a different method of reserving funds that could insulate crypto from banking risks. He's not the only one. Coinbase CEO says non-fractional reserve banking is becoming attractive. And he is even given thought to how Coinbase could engage in more banking activities, neobanking activities, in the middle of such a storm. The innovators, they're still innovating, and they're finding new ways to bank in what's a meltdown to the bankers of the biggest crypto firms.
All right, excellent. Thanks so much for that, Shonali Bassick. Joining us now is Kavita Gupta, founder and general partner of Delta Blockchain Fund. It's a venture capital firm. And let me first ask, what have the reverberations been, Kavita, for the crypto industry after the collapse of not only Silvergate, but also SVB, after we heard from people like Barney Frank that that Signature was singled out because of its crypto exposure?
Thanks, Matt, for having me. And I completely agree with Shonali that there has been a systematic approach to choke down any type of off-ramp, on-ramp solution in a regulated way. I completely agree that Signature Bank has been a target and has been a very politicized target because of the crypto community preference. I mean, look at Silvergate, Signature Bank, and SVB. You're talking about three biggest crypto-friendly banks completely disappearing from the space in US. Cross River is the only one standing, which is also becoming very shy of the crypto community. So for a lot of blockchain and crypto companies which are based out of US, now the biggest risk is even if they get their money out, where do they take it? And the latest story is most of them are looking outside US, especially in the Swiss ruling system.
Well, to that point, if they instead are just looking offshore, I'm just wondering, as we talk about tightening regulations and all of this, like here in the U.S., how that factors into this.
Really, it's just like a chicken and the egg situation, right? So you are sitting on, let's say, multi-million-dollar investment raised, and now you cannot do anything about it because you have to take your money out of that account. But JP Morgan's, Bank of America's of the world are not really up to giving you KYCs, the top four banks. So you have to take that money somewhere else. So either you just basically convert it back to the exchanges if you have the Access institutional account, convert it into crypto and take it out, or you really figure out with a Swiss account or other places and re-register your company, do your KYC. Both are difficult, but you have to do something or the other because at the end of the day, you're building a technology. It's just not trading of crypto, right?
Well, if we think back to how all of this bank run, if you will, started, it was this idea that these riskier depositors, perhaps, that are seeing funding sources drying up from the venture capital world, then really do have to tap their bank accounts, and they were withdrawing money because they aren't just getting new funding because money is no longer free. So I'm wondering if the longer term view here, especially given that you are a venture capitalist, how problematic is the funding view for these companies, let alone where they bank?
So I feel like there's always a cycle where you have a bull cycle where there's a lot of liquidity in the market, a lot of companies raise their valuation, both Web 2 and Web 3. This is just not a problem of Web 3, and have a lot of operational capital in the bank. And then there is always a time when the market is tight, there is less liquidity, there is less fundraise. Said that, I think this whole thing, if I just go back to Silicon Valley Bank, it has nothing to do with just the liquidity in the VC space. They decided to actually have a lot of their cash invested into long-term treasury bonds while giving a short-term loans away. And I think that's what created a lot of liquidity issues for them, which is a very traditional problem for the bank system to have, which ultimately impacted both Web 2 and Web 3 space. And the repercussion of that came down to all the regional banks. That's where we saw First Republic having a little bit of issue, and then Signature Bank completely disappearing because people started realizing that Signature Bank will be targeted even more and probably not be saved as compared to other banks. And I think the ripple effect, especially from the Web3 community after Luna, FTX, the trust is very, very low in the market already.
Kavita, do you expect another single bank to pop up and serve the needs that SVB did? Do you expect a multitude of banks to pop up and serve those needs? And will this failure, put a wrench in the works in terms of blockchain innovation?
So I'll take your first question. Definitely over time, may not be immediately over next 6 months, a year, 2 years, because of the banking licenses. There will be a lot of scrutiny over banking licenses. But I do see that there is a huge need. There's a huge gap to have an entrepreneurial bank. The whole Silicon Valley has supported it. They said they will continue to work with SVB of the world if someone comes in and saves. But looks like that didn't happen in US, which happened in UK with HSBC taking over Silicon Valley Bank and making sure it continues. So I feel like there's a huge need, and it will be taken care by the market over time once the panic around it subsidize. But at the same time, to your next question, at the end of the day, there is again a big need for a crypto community to have a banking system, a regulated banking system. Not every blockchain company, in fact, 99% of the blockchain companies in the space are very happy to go regulated, raise money in a very straightaway VC route, build technology and put out there, and they just want to pay their employees. They want to have simple cost operational money. And I think if we have a proper regulated system to it, this technology can be huge for US, and if not, somewhere else, unfortunately.
All right, Kavita, thanks so much for joining us. Kavita Gupta there of the Delta Blockchain Fund. Coming up, we're going to talk to Perianne Boring, founder and CEO of the trade group Chamber of Digital Commerce.
Plus, we'll have a closer look at Signature Bank's swift demise, how its foray into crypto helped lead to its downfall. We'll have more on today's Big Take story ahead.
And to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
The narrative had been, how do we protect the banking system from crypto? And I think what's taken place here is a demonstration of how do we protect a stablecoin from the banking system itself. And we have long advocated for a full reserve model for digital dollars on the internet. And we've emphasized the risks of the fractional reserve banking system as something that backs that. And so we'll come back to, I know, the regulatory questions, but the important thing here is the result of this has been that we have been able to actually move the entirety of the reserves. So we're actually coming out of this with an infrastructure, a dollar market infrastructure that's the safest in the world for transacting in the space.
That was Jeremy Allaire, the CEO of stablecoin issuer Circle, speaking earlier on Bloomberg. And Allaire confirmed that Circle was able to access its reserves at Silicon Valley Bank on Monday. Well, joining us now to discuss these bank failures further and the impact on the industry, Perianne Boring, founder and CEO of the trade group Chamber of Digital Commerce, who is joining us now from Jacksonville, Florida. So, Perianne, obviously you have a number of members at the Chamber. What are you hearing from them? How concerned are they about their ability to operate within this traditional banking system here in the U.S.?
I think this has been a huge wake-up call, not just for crypto businesses, but for all businesses across the United States, that our financial system, it's fragile and it's leveraged, just like what Jeremy was talking to. And more people are starting to understand that if you have more than $250,000 in your bank account, which a lot of businesses do, that you're considered an unsecured creditor to your bank. And a lot of people just are not comfortable with taking on that type of risk, especially in these volatile economic times. And you know what? They shouldn't have to. People deserve a safe place. People and businesses deserve a safe space to hold their hard-earned money. And what Jeremy was advocating for is a full reserve bank. Policymakers, regulators, they should be doing everything they can to restore confidence in our financial system. And a part of that is bringing new business models to market, banking business models that are not leveraged, that operate under full reserves. And they've gone to extraordinary lengths to prevent them from coming to market and preventing any competition in the banking system. So that's one thing policymakers can do, and they should be looking for new and innovative technologies like blockchain to modernize our financial system to create more transparency and efficiencies in the markets.
But do you really think there's appetite for that post these failures, post the collapse of FTX? I just wonder reputationally if blockchain is now a bad taste in everyone's mouth.
I don't understand how blockchain would have any type of role in these types of bank failures. The failures that we're seeing at the banks have to do with liquidity issues, risk management issues, and failure of regulatory and supervisory powers. This had nothing to do with blockchain, and the record should reflect that.
In terms of banking for crypto, have we lost a lot here? Have we taken a few steps back, Perianne? Because it seems that much of the industry is now working against that.
So Silvergate and Signature Bank are two banks that did bank crypto companies, not exclusively. They banked many other types of businesses as well. But there's dozens of banks across the United States that bank digital asset companies. So there are other places for businesses to go to receive banking partnerships, banking relationships. But this has always been a challenge. This was a challenge when we first opened the chamber in 2014. Establishing banking partners can be an issue. The bigger issue with both Silvergate and Signature failing is that they both had 24/7 payment networks that many crypto businesses used. The Signet platform is apparently still operational at Signature today, but if for some reason if that changes, that could cause a lot of operational challenges for businesses that need 24/7 access to payment systems.
Right. I just think, Nouriel Rabini tweeted, all banks doing crypto biz are collapsing. Good riddance. Barney Frank implied that the regulators were closing down Signature because of its crypto relationships. Kavita Gupta was just telling us that HSBC, which bought the UK assets of SVB, NatWest and others are limiting crypto transactions to £1,000 a day. It just seems like the tide has turned.
Potentially, again, the issue of debanking is something that has impacted the digital asset industry for over a decade. It's an issue we've worked on for a long time. It does seem to be somewhat renewed at this time. We are hearing rumors that the federal banking regulators are putting pressure on the banks to not bank digital asset companies. We would see that as a gross overstep of their powers, and it's something that we have pressured members of Congress to bring oversight to. That activity should not go unchecked, and it should not take place here in the United States.
All right, Perianne, thanks very much. Perianne Boring joining us from the Chamber of Digital Commerce. Be sure to check out our Bloomberg Crypto podcast, by the way, which dives deeper than the daily market buzz to explore the stories and people shaping the ever-evolving digital landscape. Look for that every weekday, wherever you get your podcasts. This is Bloomberg.
This is Bloomberg Crypto. I'm Caitlin Lyons in Washington with Matt Miller in New York. Well, a big pivot to crypto helped change Signature Bank's focus and ultimately its fate. Our latest Big Take explores the unraveling of this New York bank. Bloomberg's Max Abelson, who wrote the story, is joining us now to talk about that. So, Max, this was a story of a bank that evolved perhaps in not the right direction ultimately. What was Signature's story at the beginning of things before it got into crypto?
You know, it's funny because the name Signature Bank is obviously, you know, it's on the top of our minds. And I think most people, even if they don't follow finance, know that it's, you know, all of a sudden the third biggest banking collapse in U.S. history. But, you know, it was not Goldman Sachs and it was not Bank of America. It wasn't a name maybe that a lot of people on Wall Street knew. And, you know, it wasn't a bank that I was overly familiar with. And that's because it was sort of not quite like any other bank that we write about here at Bloomberg News. I mean, the sense that I got in a really intense kind of like 18-hour period of reporting yesterday was that, you know, what we're talking about when we talk about Signature Bank is this like outer borough, blue collar, very old school, very traditional bank that, you know, it was a place where, you know, the chairman was laughed at because, you know, he went to Northwestern, which was seen as like very fancy. You know, this was a place where people prided themselves on not having connections. And then it became something that it hadn't been. You know, it got into crypto early, and it got into crypto in a really big way. And that kind of, that changed its fate.
You know, Max, we spoke with Barney Frank yesterday on Bloomberg Radio. He, of course, the author, co-author of the Dodd-Frank bill, probably the biggest bank regulation in decades. And he now is on the board, or was on the board of Signature. He was pretty sure that regulators had singled out Signature because of its crypto connections. And he is someone who's very well versed in bank regulation, right? So do we listen to that, or do we take his comments with a grain of salt because, you know, that's where he's drawing a paycheck most recently?
Well, I'm glad you bring up Barney Frank because, you know, I just described to you this bank as being, you know, outer borough and blue collar. And I think it's pretty important to know it also is like very quietly well connected. It had Al D'Amato, former senator from this state, on the board. It had Ivanka Trump on the board briefly, and it had Barney Frank on the board, the Frank and Barney Frank. You know, regulators came out and have said, Max Reyes, a fellow Max on the Bloomberg finance team, he just broke the news that basically the way regulators see it is that this wasn't about crypto per se. This was about them, you know, having a crisis of confidence in Signature. So I think if Barney Frank is out there saying, you know, they were picking on us, I think regulators are starting to get out the message like, you know, not so fast. We utterly lost faith in you, Signature. But, you know, it does raise a fair point, and one that we write about in the story. I hope everybody checks it out. It's the Big Take today. That, you know, this was not a simple thing where it's like they got into crypto and so they failed. You know, I think that we have to talk honestly about the fact that, you know, depositors and a bank run played a huge role. And we spoke to someone, we spoke to someone who ran on Friday. You know, bank runs are not abstract. Like they involve people who are running.
Yeah, there's a lot of,
there were depositors running on Friday, and you know, this is
in a big way we saw that run. Max, unfortunately, we have to leave it there, but great story. Check it out on the terminal or online. Bloomberg's Max Abelson, thank you so much. And tune into Crypto next week, Tuesday, 1 p.m. Eastern, right here on Bloomberg.